future. We're talking real money.
Well, it's my favorite day of the week, of the podcast week, and apparently it's also Tom's grandchildren's favorite day of the podcast week for some strange reason. Yes, ladies and gentlemen, TGIQAF. Not TGIF, but TGIQAF, Question and Answer Friday. I'm Don McDonald. So glad you could join me on our little get-together on the internet. The modern version, or the soon-to-be modern version of radio. Radio. I'm telling you, radio it's slip sliding away. Particularly talk radio. There's so much more talk and information and conversation and stuff, just great stuff to be listened to on podcasts that it has to be hurting informational radio. And then, of course, Apple Music and Spotify have to be hurting music radio, so radio's hurting. There's just so many great things to listen to. So that's why I love doing the podcast, and I love this one in particular because this is when you get to send your questions in, and then I get to answer them, which is the thing that I've been doing about money let's see, since 1988. So send your questions in at talkingrealmoney.com on the contact form. I prefer that you speak them because if you type them, then they go to Tom's grubby little pile of paper, and then we have to work through that. If you speak them, you can be very, very confident. There's a very good chance. It's not 100%, but it's about 94%, maybe 96% chance that your question will end up on the Friday Q&A. There are a few exceptions, but I'm not going to get into those now. So send in those questions. Speak them in at talkingrealmoney.com, or you can call us on Saturdays when we do a radio show at 855-935-TALK, Saturday 3 to 5 Eastern Time. Now, let's get to that thing I like. The first question.
Hi, Don. Thanks for the great show. Are most people better off to put their money in an ETF like SGOV instead of a high-yield savings account? Especially since SGOV is paying a little more than most high-yield savings accounts. Plus, people like me who live in California, which, as you probably know, is the highest taxed state in the country, and I understand SGOV is exempt from state taxes. So isn't it kind of a no-brainer to put your kind of emergency cash in SGOV rather than a high-yield savings account? And I understand that it's not. If you really needed money right away, you have to sell SGOV and then wait for the cash to go to the account. But that's only going to take a day or two, and I think I could use my credit cards if I had a dire emergency until I could pay them off. Anyway, what are your thoughts?
Well, that's not the only downside to SGOV, which is the iShares 1 to 3 month Treasury ETF. It holds very short-term Treasury securities, which are full faith and credit of the government, which means they're very safe. The yield is right at the upper end of the high-yield savings market, about that 4.1, 4.2. That's where the highest yields are in savings too. Most are below that, though, correct. However, the high-yield savings accounts will always be worth, every dollar is going to be worth $1. Put $1 in, you'll get $1 out. Not necessarily the case with SGOV, because SGOV trades day to day like a stock. Therefore, if interest rates fall, the value of SGOV will actually go up, making it even better. But if interest rates rise, the value of SGOV will go down a little bit. Now, the good news is its longest maturities are 3 months. Therefore, they're turning that portfolio over relatively quickly, bringing new bonds in, increasing the yield to make up for the loss in net asset value. So it shouldn't be a big deal, but that's something that everybody needs to be aware of. There will be fluctuation of the value. If you're okay with that, SGOV is a very safe, just not absolutely non-volatile safe option versus high-yield savings accounts. So, yes, it's fine. Just be aware of that. And thanks so much for the question. Now let's do the next one.
Hello, Don. I had a question about two small cap value ETFs by Avantis and Dimensional. I know that Avantis are kind of breakoffs from Dimensional Advisors, and I wanted to compare their two small cap value ETFs. By a factor regression analysis, the small, the size, the value premium, like all of those factors match up almost statistically the same when you look on Portfolio Visualizer. But if you look at an ETF overlap website and you plug in the two tickers AVUV and DFSV, they only overlap by 40% by weight. So if they're both rules-based, how can the rules be so different that their weightings are that different? Is this just manager alpha? Are they slightly more different than what we're led to believe? Or could it be explained by some other nuance? Thanks.
They're different. They're different. They have very similar rules. I mean, of course, they're small cap value, so their rules tilt towards small and value, but there's a difference in the rules at dimensional funds and Avantis. Dimensional funds, think of dimensional funds as the more buttoned down, purely, what's a good explanation? They tend to be a lot more conservative in their approach. So DFSV has a broader, more diversified portfolio. AVUV is more focused on really small and really value-oriented stocks. DFA is going to have stricter screens. They are going to have a more patient approach. They are their rules. I really think that the biggest description, the best description I can give, is that AVUV is a little more wild and DFA is a little more subdued in their approach. AVUV has really cheap, troubled companies sometimes, and DFA has filters to try to avoid problem children. However, those problem children, if they recover, can be incredibly profitable. So let's put it another way. AVUV is probably a more risky, I would say, no, I'm going to say probably. Yeah, AVUV is going to be a more risky fund. It really is. It might behave better. It might make you more money, but risk and reward go hand in hand. If the reward potential is greater, then the risks are higher. For example, both screen for profitability. They both have profitability screens. If at DFA the profitability declines, they will very quickly kick it out of the portfolio. At AVUV, they may hold off for a while, particularly if they've got a great value proposition. They may say, okay, we'll wait on the profitability. So their rules are a little looser. I guess AVUV actually maybe drifts a little bit more into activity or actively managing, although, again, both are rules-based. I hope that explains it. But AVUV is just a little wilder fund. They're pushing the envelope just a little bit. Thanks for your question. It was a good one. And here's our next one.
Hi, Tom. Hi, Don. I just thought you would like me to leave a voice recording message. I've met you before at the seminars, and it's always been a very nice interaction. And I thought I would thank you by calling and leave a message on the recording instead of typing at this time. You mentioned a lot about the importance of diversification, and I agree wholeheartedly, and also having stocks and bonds and a nice mix of international. But since you also say time and time again the impact of international stocks and how well they do, why don't we have even more of international in our portfolio, like say 70% international of the equities that you're going to invest, and have a smaller portion of domestic? There must be some rationale. And even though you can't take past results and extrapolate them into the future, don't we do that already in everything that we do as far as evaluating even AVGE and AVUV based on the fact that the performance of small caps has done well over a 20-year period. And you say based on that, it's better to use those funds than, say, even a S&P average like VOO. Looking forward to hear your response. Thank you very much. It's not as painful leaving a message as typing as I thought it would be. Take care. Bye.
Well, when you're a bad typist like I am, dictating or speaking is always faster. I'm a terrible typist. And yet I write all kinds of stuff. I'm better speaking it than I'm better just doing a podcast and speaking everything so it doesn't get transcribed. Anyway, to your question. Well, one, yeah, you might be right if your assumptions were correct. But no, we have never, ever, ever said international stocks perform better than U.S. stocks. We've never said that. You misunderstood. We have said that international stocks have bailed out strictly U.S. equity investors in the past because they don't always zig or zag at the exact same time. They're not negatively correlated where one is up and the other is down, but they don't always move in lockstep, as we are seeing right now. The best performing stocks recently have been international, whereas the past couple of decades, it was U.S. So they perform differently, but we would have never said that international stocks beat U.S. stocks over a long period of time because they don't. I mean, if we look at the total market indexes, the MSCI US or the MSCI EFA, the Europe, Australasia, Far East, it's easy for me to say, you'll see that the numbers heavily favor the U.S., and I do mean heavily, in large part because of that 20-year period where they did so much better. So, I mean, the U.S. total market from 1970 through 2024 returned, these numbers will be a little better now with 2025 factored in for the internationals, but it was an average annual return of about 10.5% for the U.S. over 50 years and about 2.5% less annually for the international developed markets. So that's a big difference. But we still don't think that should tell you that you should buy more U.S. because having done better doesn't mean it will continue to do so. That 20-year extraordinary U.S. period throws the numbers off a little bit. And again, we don't think the international markets are going to outperform. We don't even think they're likely to outperform. We just want them in the portfolio to reduce that incredibly important factor that every investor deals with, and that's volatility. We want the volatility down. That's why I'm an advocate of the 50-50 mix, which is back where it was about 20 years ago. But most funds do something close to a 70-30, 70% U.S., 30 international. If you want more, you can just boost that with an international fund or pick up a international small value fund to boost your small, your value, and your international. But no, there is no evidence that international stocks are likely to do better over time, nor is there any evidence that U.S. stocks are likely to do better over time. We don't know. And again, the reason we say small cap and value are likely to do better over time is because there's evidence that they have. There isn't evidence really for the U.S. There is some for the U.S., yes, but no great reason for that. There's great reason for value and small outperforming because you're getting into securities that are out of favor or have more room to grow. Another big reason the U.S. market did as well as it did over that 50-year period is the strength of the dollar for most of that time. That helps. Anyway, thank you for your question. We still have more. You can send yours in at talkingrealmoney.com on the contact form. You can also call our radio show live on Saturdays from 3 p.m. to 5 p.m. at 855-935-TALK, 855-935-8255. Here's our next question.
Hello, Don and Tom. This is John from Wisconsin. Love your show. Love the banter. It's great. I learn a lot, and I laugh all the time. Tom, you just keep telling your jokes. They land. Every one of them land with me. Guys, I want to talk to you. Get your feedback on S&P 500. I just was listening to one of the recent podcasts talking about the Magnificent Seven make up nearly 40%. I mean, it's 34 and change, I think. Wanted to get your feedback on options like equal weighted ETFs, specifically EUSA. And is that an option to diversify so you're not so heavily weighted S&P 500 and those 7 specific stocks? Again, keep up the great work. I'm going to keep listening, encouraging others to do the same. Thanks.
Thank you. And I left in the part about Tom's jokes. I was going to edit that out because I have the power. I have the edit power. I don't use it. I try not to use it. It's an awesome power, and I have to be very careful how I use that power. So I didn't take that out, even though I don't want to encourage him. I mean, a few bad dad jokes, one thing, but constant? Never mind. Anyway, equal weighted funds. Well, an equal weighted fund versus an S&P 500 fund, like the EUSA, which is, by the way, the whole U.S. market. It's the entire U.S. market, equally weighted. That's a lot of stocks, and there are some problems with that. One, to keep that equal weighting, you got to trade a lot, and some of those stocks are going to be expensive trades. They are, and that's going to detract from the returns. It's not going to be reflected in the fee structure. It's reflected in the returns. And the other thing is that basically what an equal weighted fund is doing is, without trying, they're overemphasizing small company stocks, dramatically overemphasizing them. So it has a small cap tilt, maybe even a little bit of a small cap value tilt, which makes it sound a lot like what Avantis and Dimensional do with their tilts. However, Avantis and Dimensional, using a rules-based approach to get there, probably have a better tool for doing so. And historically, that's been the case. If we lay the performance, now remember, Dimensional and Avantis don't have 10 or 15 years performance on their ETFs yet. But Dimensional does on their mutual funds, like their U.S. Core Equity 2 fund, which has been around for a long time. And we can compare returns. Now, again, these are not indicative of the future, but if it's pretty consistent, that tells you something. That maybe DFA and Avantis are onto something. And just let me give you a couple of examples. Let's start out with the short term, which we really don't think is a fair comparison, but why the heck not? Let's look at EUSA over 1 year, 4.8%. Let's look at the Dimensional Core Equity 2 fund over 1 year. More than double that, 9.29. Over 3 years, the Dimensional is at 18.6. The EUSA over 3 years is at 14.1. 5-year return, 15.1 with Dimensional, 11.1 with the equal weighted fund. And let's just skip 10. Well, 10 is 1062 for the equal weighted. 10 years is 12.60 for the Dimensional fund. And then at 15 years, the Dimensional fund is 12.8 versus 11.4. So as you see, as we get further out over time, they become a little more equal. But considering the fact that you really are saying, I want a small value tilt when you say I want equal weighted, well, you might as well just go whole hog and get small value tilt, although there's nothing wrong. I would rather use EUSA in a portfolio, much rather use it than VOO. Just have the S&P 500. I just don't like owning the S&P 500. So if it comes down to an index versus an index, a pure index versus a pure index, the EUSA, which is the iShares MSCI US equal weighted ETF, would be my preference. Thanks for the call. Thanks for the question. Again, send them in, talkingrealmoney.com on the contact form. Call the show on Saturdays, 3 o'clock, 855-935-TALK. And here's our last question of the day.
Hey, Don. Happy Friday. This is Nikola Jokic from Denver. Just calling. I got a couple of questions. I wish Tom was here. Also, for my second question, I wanted to hear you two debate that, but I'll run it by you anyway. My first question has to do with a friend of mine that asked about where he wants to put 2 to 3 year money. Of course, I told him high yield savings, CDs, T-bills, like the usual. But I thought if he wanted to invest it a little bit safely, I figured maybe he could go with a current year or a 2030 target date fund. I thought a second option might be to invest it all in BND. And a last option, I got a couple of moderate growth funds that are pretty inexpensive. AVMA, that's about a 60-40, 0.21% expense ratio. And V like Victor, S like Sam, M like Mark, GX. VSMGX is 0.13 expense ratio, but you do need a $3,000 minimum purchase for that one. So just wondering what you thought about 2 to 3 year money and those ideas.
Well, before I get to the second part, let's do the first part. It depends. That's my answer for everything, isn't it? I don't know enough about the 2 to 3 year time frame and the need for the money at the end of that time frame. Because if that money must absolutely positively be there in its entirety, plus some interest, at the end of 2 to 3 years, then the target date idea is a bad one. The balanced funds are terrible ideas. Because both of those, in a really bad market, let's say, the end of 2025 or the beginning of 26, we have a terrible, terrible, terrible bear market. Those funds could drop by 15 to 30%. Could. I'm not saying they would, but they could. And if that's going to hurt the person who needs the money in 2 to 3 years, it's a bad idea. The riskiest I would go would be BND. And even there's the slight risk of an up to maybe 10% decline in the value because of fluctuating interest rates and some of the longer-term bonds in the portfolio. So if it's absolutely money that must be there, high-yield savings, maybe a CD ladder, individual bonds or something, but not the target date. If there's flexibility, current year target date fund is a great way to get diversification and not a crazy portfolio. So that may be the way to go. I'd need to know more. Let me get to your next question now, and I'll have to play both parts because Tom's not here.
Question number 2 is not really a question. I know you guys have been talking, and I always have the same question too. Avantis and Dimensional keep listing their items as actively managed, and you guys a few months ago were asking for a better description than actively managed. And I just was wondering if you think a better word, because it's system investing more than anything, if systematically managed might be a better phrase for those descriptions. So that's it. Thank you so much for all you guys do.
I don't think we have to debate. I think we'd agree. It's a reasonable idea. The problem is systematic investing is like dollar cost averaging. And I think that might confuse people. We're going to kind of stick with, until something really great comes along, rules-based. We're just going to use the term rules-based or academic research, because that's basically what it is. They're looking back at the past, trying to develop rules, and they strictly follow those rules. But the rules can differ, as we mentioned earlier, between the two groups. They still follow their rules. There's no hunch work going on. There's no predicting going on. They're not trying to predict future earnings. They're just looking at what they've been. They're not trying to predict whether they're going to grow or lose money in the future. They are just basing it on what they've done, where they fall. And if they no longer fall in that category, they're out eventually. Maybe not right away, but they're going to be out. Again, Dimensional is going to take their time getting them out. They want to do it more slowly so that they don't impact the NAV quickly. But rules-based, I like. It's okay. I don't like active, again, because it implies guesswork, even if it's not there. I get that they're more active than passive because they've got rules and they've got to do things. They don't just blindly buy an index. That's purely passive. So there is something, it's an in-betweener. Thanks for the ideas. Thanks for the questions. Thanks for the fact that you spoke them instead of typed them. Good for you. Wasn't it easier, really, when it comes right down to it, isn't it easier just to speak? Particularly if you're alone and no one's listening. You know, sometimes when you do it, it's hard to dictate when there are people around, right? Or to speak those things. But if you're by yourself, it's easier. And keep doing it. Go to talkingrealmoney.com, click on the contact form. If you want to meet with a real-life fiduciary advisor who isn't going to try to sell you anything, I promise, Scout's honor, and I was once a Weeblo, as far as I got. That's another story. My childhood was weird. But now I lost track. Oh, just go to talkingrealmoney.com and hit on the button that says meet an advisor and set up an appointment with one of our advisors, and they'll help you out for free for a bit. Now, you can't work with us for life for free, because then how do we make money? Kind of important that you do that because, well, you know, we're talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.